Today we're talking about 529 college savings plans. You're going to learn exactly how to get both state income tax deductions and how to qualify for the federal income tax rules on there, how to get the most out of your 529, and even what happens when you have leftover money with your 529. First, let's talk about the state income tax deductions. And those are specific to the state themselves. There are roughly half the states that give you a tax deduction, and quite often, most of them, only very few of them, give you a state tax deduction if you choose any 529 plan. The ones that give you the state tax deduction, most likely you have to actually use your own state 529 plan. So one thing to look up is whether your plan gets a tax deduction at all. I've got a link in the description that has a guide to the different states and which ones give you the state tax deduction, as well as which ones they have that reciprocity where it doesn't matter which 529 plan you use. But most plans do need to be direct through the state, which is why you'll quite often find at the state even two different plans, where there's a plan that is direct to the investor. And quite often those plans are cheaper. I'll talk about that soon. But you could also get it through your financial advisor. And if you are buying your 529 through your financial advisor, find out if that plan qualifies for your state income tax deduction. It just might not be the case, where you could be in a state that you could get a state income tax deduction and the advisor might not be actually selling you the plan that you get that state income tax deduction. Another thing to keep in mind is, how is your state income tax deduction generated? I'm in Wisconsin, and for Wisconsin, it's per beneficiary. So if you were to write a check, send money in to one beneficiary, 50 different beneficiaries, for Wisconsin, it's $5,000 per beneficiary. You could get 100,000 of state income tax deductions if you give enough money away into the 529 plan of different beneficiaries. For Illinois, my neighboring state, it's per person that's putting the money in. So it doesn't matter if they put the money into one person's plan or 50 different people's plans. The amount you can put in for Illinois is $10,000 per person. Of course, if there's a couple, that's $20,000. Just using those two as examples, that there's a difference between, are you getting a deduction based on the number of people that you put the money in, or are you getting the deduction as being the one person yourself who puts the money in, no matter how many students you're helping out there. Now for the federal, there is absolutely zero tax deduction in any way. You put money into a 529 plan, you are not getting a tax deduction at the federal income tax level. What happens though is, as your money grows, you're not getting a 1099, you're not paying any taxes along the way, and if you take the money out for that qualified higher education expense, the money you took out, that's tax-free. So you can put the money in, allow it to grow without a taxable event along the way, and take the money out tax-free as long as you meet the rules. You might be wondering about contribution limits. What's the maximum you can put into that 529? Now the maximums are really different per state. There is truly a maximum that you can put in, quite often around the $500,000 level. You've got to look it up at your state, that $500,000 level, let's go with that, which means that if the balance itself and the beneficiary, right, the student's account, if the balance gets to $500,000, you're not allowed to put any more money into that plan. So it's pretty tough to get there. You might actually get there, especially if you're using it for estate planning purposes. So quite often when you're seeing what's the maximum, you might hear a number of $18,000. $18,000 being the 2024 gift exclusion. You can actually put in more than that. It's just that that $18,000 doesn't count towards your gift tax situation, right? You get to exclude that. You don't have to tell anybody. You don't have to fill out a form. So you could put in $18,000 towards one beneficiary, and you could actually do 5 years of it. Some people call that super funding, where you could put in the 5 years, $90,000, and that counts towards this year, the next few years of the gift tax exclusion. If you put in more than that amount, even more than $90,000, that's allowed. It's just now you're putting it on the gift tax form, and you're just tracking that to see if you ever have to pay any gift taxes on that. So quite often you're using that gift tax exclusion just because it's easy, right? It's easy not to go above that level and not have to report it at all. perhaps it's easy to do the 5 years on it. And when you're talking about actual contribution limits, it's per state. And it's not like they're stopping you from contributing to 529s. They're stopping the beneficiary. They're stopping the student from actually receiving any funds into their account as a contribution once they hit those levels. Again, it's by states. 500,000 roughly is what you'll quite often see. I've talked about putting the money into the account for the 529. As you take the money out, you'll want to make sure it qualifies as a higher education expense so that it's tax-free. Now there's federal rules. Those federal rules just changed in the last few years, so we'll go through all those. Now the federal rules, it's the ones that you might be thinking of. We're talking post-secondary, which you might be thinking of as the ivory tower college, type of movie situation. No, it's post-secondary. It's technical schools. It's nursing schools. You can learn how to drive a semi-truck. There's different things that qualify as long as it's accredited and qualifies as post-secondary. After high school, that counts, and you can then use your tuition and fees that are required. You can take that out of the 529 tax-free. The books, supplies, equipment that's required by the school, that's tax-free. So just because you like books and you buy a bunch on Amazon, those don't all qualify, right? It's got to be required by the school. You can even buy a computer, pay for the software, pay for the internet access as long as it's for the student primarily on there. And it's got to be educational, right? You can't have your mine coins and your Robux. That stuff's not going to count at all. Qualified room and board as long as you're over a half-time student. Half-time is whatever the school says is half-time. So find out from the school, what is the room and board amount? What does half-time count? Is the student enrolled and counting as over a half-time? There's internship programs. There's apprentice programs. Those count. There's even where you can take $10,000 out of the 529 plan and pay down the student loan debt that was for expenses that already occurred. That's a new rule from a few years ago. Also, at the same time, there was a new rule added that you can use it not just for post-secondary, but qualified elementary and secondary, so K through 12 education. This is quite useful, especially if maybe grandparents are wanting to help out and pay for the private school, for the church school, for the kids that are K through 12, where perhaps they could put the money in and get a state income tax deduction. Quite often then you can't take the money out till after a year. You can't put the money in today, take it out tomorrow, and get that state income tax deduction. But perhaps the parents, grandparents then are helping out with the cost. They can maybe get a state income tax deduction, hopefully maybe earn a little bit of return, and then take it on out for that K-12 education. So that's a new rule with the student loans counting, with the K-12 counting as you're taking money out of the 529. Although take a look, there's some states, like Illinois in particular, where they don't allow the K-12 to count on the state income tax, which means that if you had previously got a deduction and the money goes then towards the K-12 on that state, so for Illinois, on that state, they may then take back that deduction. They just didn't allow that new addition to it. Remember too, you cannot double dip. You can't buy a computer or pay your tuition and say, oh, this counts as my 529, and it counts as I took money out of this Coverdell plan, it counts against the scholarship that I got for it, and it counts for these lifetime learning credits and American Opportunity credits. You can't double dip. $1 of education expense can only be provided and counted towards $1 of a tax benefit type of situation. So write out all your education expenses, put it together in a spreadsheet, and really just assign, okay, where are you saying this money came from? Because you don't have to actually take the money from the 529 and send it directly to the college. You're actually just kind of reimbursing yourself, just like you might reimburse yourself from a Coverdell plan, or maybe even get reimbursements through work for some type of education situation. You can only use $1 towards $1 of some sort of benefit, which might get you thinking, can I have too much in a 529 plan? I hear that quite often. It's pretty tough to actually have too much in a 529 plan, but if you did and you took money out towards any other reason that's not the qualified education expense, there would be a penalty of 10% on the gains, and you would pay the federal income taxes on that money. Kind of like if you took money from your traditional IRA early, where there's an early withdrawal penalty. When I say it's tough, though, it's tough to have too much money in the 529 plan for a few reasons. One is you can always change the beneficiary once every 12 months. So maybe the older sibling didn't use all the funds. You could shift the beneficiary to the younger sibling, even a nephew, even back up to the parents. Maybe you're a grandparent, you gave some money to the grandkids, they didn't use it all, and the parents are going back and getting an extra degree. They might be a teacher and they're getting continuing education credit that counts on there. You can even switch the beneficiary on up to the parents and get that. So it's quite hard to not use the money towards education. And there's even now a new rule that allows the beneficiary, allows you to take money from that 529 plan and switch it on over to a Roth IRA. It's up to $35,000 that you can do that. It's a really new rule. It's basically in flux. A lot of rules on there. Different financial institutions are interpreting it different ways. So it's not quite settled exactly how to do that, but that's an additional way that you can take the leftovers, the extra money from the 529 and shift it on over so that you're not being faced with that 10% penalty. So look into those 529 plans for college savings. Look into it for even ways to reduce your estate. Especially look into the difference between buying it from an advisor directly versus directly through the 529, where everywhere I've looked, the direct 529 plan is a much cheaper option compared to buying it through a financial advisor. Try to get the most out of your state income tax deductions. Find out if you even can get the state income tax deductions, and especially if you're buying it through an advisor, that you do get that state income tax deduction by getting the state income tax rules. Quite often the Illinois or Wisconsin or whichever state, those plans will have two different options, the direct plan, the advisor sold plan, and quite often, usually, you'll have to have the state-specific plan to get the state income tax deduction. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.